Hey guys, welcome to episode 1 of Vlogtober. I know I haven't been consistent here on YouTube. The only thing that I'm consistent with right now is my studies. Today's backtest with me video is inspired by me balancing school and trading. I think I got the formula. I just want to give a few shout outs, okay? Number 1, Artful Unkemeti, shout out to you, because in my last backtest with me video, you said I should incorporate fair value gaps into my strategy. Thank you for that, because I have been trading fair value gaps and it's helped me name something that I would see in the market, but I couldn't name it. And shout out to you too, Duke Nkosi, because the last time you wanted to see my perspective of UJ or oil. Unfortunately, I don't trade oil yet. I only trade Forex, so I'm gonna do UJ. You guys might have seen yesterday on my channel, 2 days ago when you guys are watching this, I posted a full audio book of this book. It's called The Disciplined Trader by Mark Douglas. This book is one of the books that helped fast track my road to become a consistently profitable forex trader. Mostly like overcoming my mental environment. There are a few things that I'm going to use from this book while I'm backtesting. It's going to be my first time backtesting this stuff on UJ, so this is going to be a raw video. If you like this kind of content, don't forget to like, comment and subscribe to my YouTube channel. It really helps me reach a wider audience. Let's jump into it, guys. Before we start, I want us to define in words what a fair value gap is. Fair value gaps occur when a large price movement creates a gap between the high of one candle and the low of the following candle, which do not overlap completely. I want to show you guys a visual representation of this. Is a candlestick, right? In this case, we are gonna say that the market is bullish. So let's make the candlestick pink, right? And then there is the other candlestick that maybe starts here, but it's an engulfing candlestick, right? And then there is another candlestick that maybe goes up till here, right? And the wicks, let me draw the wicks. This is a wick. I'm just gonna clone that, and then I'm gonna take this, put it here. It's not perfect, but yeah, you guys can see what I'm trying to communicate. And this little space right here is the fair value gap, okay? Let me change the color to gray. So that space right there, is a fair value gap. The high of one candlestick. So when they say the high of one candlestick, it's basically this high that they're speaking about and the low of the other. And this is the space that that's the gap that is being created, right? And then which do not overlap completely. So there is no overlap between this candlestick and this candlestick within this candlestick. So basically, that's how I define a fair value gap. It's known that the market is not always perfect. So there are different types of fair value gaps that appear in the market. Let's try and find them. I first find the high and then the low, okay? I'm gonna take this low. I'm also gonna introduce certain things that I haven't really done with you guys before, like the line chart. One of the things that I used to do back in the day a practice that I stopped doing is changing the chart to a line chart in order for me to see where the turns are, so that I can look at that. What about this one? Let's see how that looks when we turn it into a candlestick chart. Perfect. So now I'm gonna look for fair value gaps. Price went from there to down there, right? To up. Okay, this here is a fair value gap. I'm going to delete this. That, I don't know if you guys see that. That is a fair value gap. Let me zoom in. I don't know if you see that. Here, that is a fair value gap. So I would like to see how the market reacts in all of these fair value gaps that I'm going to find. From here, the market goes up, correct, right? But then it doesn't go into the fair value gap to cover up the imbalance, and then it goes up, right? And then I see another fair value gap right here. Now, like around here. This is also a fair value gap, guys, because when we look here, this is the high of one candlestick, this is the low of the other, and this is the gap that is created from a large price movement. Cool. Now I'm gonna look for more. Then the market goes from there, right? It comes here. It goes up till, let me bring this down. And then from here, price goes up. Here's a fair value gap right here. Okay, no, it's not. Goes up to here. This is a fair value gap right here. So all of those are bullish fair value gaps. Okay, there are also bearish fair value gaps because whatever patterns are created when the market is going up, they're also created when the market is going down. It's just that it's the inverse of the bullish, being bearish. There are certain fair value gaps that are invalid, right? Such as this one, invalid. This one, invalid. Maybe let's talk about why they are invalid. It's invalid because market came back in to fill this one, right? So that's what makes that one invalid. Then the market also goes down to this one, invalid. Okay, this one not so much. I'm gonna leave it open, okay, because I'm just gonna leave it open because I want accurate results. Just want to be able to see and read price and understand. This one too, we're leaving that one open because price has to come down and then go up from there. Cool. Once the market fills in that fair value gap or closes that gap, it has filled in the imbalance. That's the word that they use. Before I allow price to play, I want to put in my positions, okay? So this area right here is a buy position for me. Not forgetting that the take profit area in this case, it can be anything starting from here to here to here to there, and then having an overall take profit that is the nearest high. Let's find the nearest high, by the way, from that area, off that area. So if price is there, the nearest high is, let's do a line chart here. But I also like this area right here because it's a wick and it's a high. Price reached that area. Cool. So now we're gonna go back. Therefore, that is my ideal take profit. And then we're gonna allow price to play. Go down to 4 hour, allow price to play. Another thing, guys, that is, that I cannot ignore is this position right here. Let me move this here. Yeah, it's this position right here, right there. Okay, so market can be triggered there, in and then out. So something like this. I also don't want to ignore the fact that this move right here could be this move. Cool. Before I play price, I want to go to the disciplined trader. As traders, it is essential that you be able to observe the market's behavior from an objective perspective. So basically in this book, he debunks all of the things that we never really understand. Why is it that we cannot overcome certain things in trading? He talks about how our memories influence how we read the market and how we react towards the market, right? And he says that do not react to the market. Allow the market to react and then you follow your plan. Stick to the plan. The following questions that I am going to use are questions that have helped me to look at the market objectively. Then From the information that I get from here, I then conclude whether or not it's a good trade for me to take. This question is on 216 if you have the book, aka chapter 16, and it's in the section where he talks about step 5, learning to think in probabilities. There are certain questions that I have skipped, but if you want to have the full experience of the questions in this book, go check out the audiobook. I will link it in this video. I'm going to answer the questions based on these positions before entering. So, question 1 says, what is the market telling me at this moment? So, at this moment, we have already concluded that we are seeing bullish fair value gaps, right? Bullish fair value gaps. Okay, another thing that I am seeing, right, is that I'm also seeing the market that it's currently correcting, right? Just came from an impulse correcting. Also, this move could also be an impulse. Because I've got a lot of in-market experience, I know that this candlestick is an impulsive move, right? So now, knowing that, this is how I would like to read the chart. Now, I've already mentioned that the market is never perfect, right? So it corrected in a bearish form, and now it corrected in a bullish form, and then it impulsed and then corrected in a bullish form, right? Now, having read that information, I want to see if the market will break this red area and come retest it and go up. That's when I will know that this entry will be the entry of this move. If the market doesn't break, it will just come there and then go down, respecting this ceiling up here. Okay, that could happen. So now let me answer this. What is the market telling me at this moment? I'm seeing a bullish fair value gap. I'm also seeing if market will respect the ceiling. Full stop. I also want to see if what is it telling me? It's telling me that it's at the ceiling. Yes, it's at the ceiling. And then it also corrected in a bearish manner and impulsed into a possible fair value gap. So when I say the possible fair value gap, I mean that area right there, the entry that we spoke about not so long ago. I want to see if this is a correct statement, and then it corrected in a bullish manner, as if it is getting ready to go down or respect to the ceiling. That is what the market is telling me. And then question 2 says, how much strength is there? For me, the strength that is there, man, I feel like at this moment it is a 50-50, because the same amount of strength, I could say that the market is going up and then it corrected, right? And then it impulsed, went down, came back up, right? And then corrected going up. But then it's in a big corrective move. So, which is confusing, because that corrective move makes me think that the market maybe wants to go up, break the ceiling, go down to the other ceiling, and then the previous ceiling then becomes the floor, and then go back up. So how much strength is there? Right now, I would say it's a 50-50 chance. Another reason why I'm saying it's a 50-50 chance is because right now, the market hasn't really broken to go up, right? I would normally take, if I take the break up, I will wait for the break, okay, and then maybe put my stop loss there and then have that area as my take profit. That's how I would enter the break. Number 4, is momentum building? I would say yes, momentum is building because has not broken yet. Market has not broken anything yet. I'm waiting to see if it will respect the ceiling or break the ceiling and respect the floor, right? So what I mean by respect the floor is that I am talking about this move right here, this retest. Because if it breaks the ceiling, right, the ceiling changes, it becomes the floor. This is the new ceiling, this is the floor, and this is the old ceiling, right? And now this is the new floor, this is the new ceiling. So it'll break the old ceiling, come to the new ceiling, come to the floor, retest the floor, and then go up and break, right? Number 6 says, what would have to happen to indicate the momentum in changing? Like I said, breaking of the floor and the ceiling. So we've already got the answer for that, okay? And then number 7 says, is the trend weakening or is this a normal retracement? I cannot define that yet because I'm still waiting to see which one of those it is. Remember, we spoke about all of that in the analyzing of the chart, right? And then number 8 said, what would show that if the market has displayed a fairly symmetrical type of pattern and that pattern has been disturbed, then it is a good indication the balance of force has shifted. So basically, number 8 is a continuation of number 7, right? It's basically a 7.2. So let's go back to number 7. It says, is the trend weakening or is it normal? Or is it a normal retracement? I said that it is, we cannot define that yet because either one of the two could be happening, right? Now, 7.1, keep that in mind. 7.2 says, what would show that? So what would show that the trend is weakening or the trend is a normal retracement? I've already said this, right? The market corrected going down and then it impulsed down, came back up, corrected going up. So that is what is showing me that the trade is weakening, right? So now I also need to prepare for what if the market goes down and not up, okay? And then I would like maybe this fair value gap right here to be my take profit area, okay? And then now I'm gonna delete that because the more I'm asking myself these questions, I can read the market objectively. So it's like I'm reading the information that the market is giving me and I'm using this to filter out the information and get to the right bias, right? And then it said, if the market has displayed a fairly symmetrical type of pattern and that pattern has been disturbed, then it is a good indication the balance of forces has shifted. The market impulsed and then it corrected, right? And then it impulsed going down, whereas it's supposed to impulse going up. So in this case, my symmetrical type of pattern is that the market is impulsing going up, correcting going down, impulse going up, but now it impulsed going down, which then raises a question in my head, like, why is that? Okay, and then it corrected going up and it's correcting going up to a ceiling. Another thing, guys, that I actually want to bring to your guys' attention is that we are looking at the 4-hour chart. These things could be happening in a span of like 2 days or 3 days, all right? And then obviously going down to the smaller time frames and looking at what I'm seeing, reading price action from that. We will get to that in a moment. So number 9 says, are there any places where one side will definitely gain dominance over the other? Definitely yes. At this area right here, market could come down, right? Play here and go back down, like I said right here at the ceiling. Or it can come, break the ceiling like that. And then it says, if that point is reached, it still may take some time for the other side to be convinced they are losers. Definitely yes. Now, this is how we place trades. My trade is actually wrong and the market is right, and the market is trying to show you, but we're like, nah man, I'm still in the game. And following this questionnaire has helped me eliminate those kind of trades. And then it says, if that other point is reached, it still may take some time for the other side to be convinced they are losers. For example, there are people riding this buy going up, right? So they're going up and they are looking at this red corrective move, right? The market corrected, went down. And then they are now looking for an impulsive move going up, right? Now, usually this impulsive move would have to be like a very big engulfing candlestick. Something like this, right? It may not be as big, but should be engulfing, And these are the things that you notice when you've got in-market experience. The more you practice, the more you see. We're still on number 9. Are there any places where one side will definitely gain dominance over the other? If that point is reached, it still may take some time for the other side to be convinced they are losers. So, some people will still not see this. They will see something like this and still think, nah, the market is still going up. You thought. So now he says, how long are you willing to give them to stampede out of their positions? For me, I would answer this question by saying that until I hit my stop loss. If they don't stampede out of their positions, what will that tell you? So if you are in a position and you are in loss and you're not exiting, usually what would be going through your head? Would you be revenge trading, or would it just be you like trading the way that you trade? And if that's the case, man, I don't want to be the one to say it or discourage you, but that's the wrong way to trade, because you gotta manage your risk. Number 11 says, what did traders have to believe to form the current pattern relative to the past? Remember that people's beliefs don't change easily unless they are extremely disappointed. People are disappointed when their expectations aren't fulfilled. I think for me, guys, I'm so used to following my trading rules, and I've gotten such great results following my trading rules. These are the questions that help me get to me making an informative decisions and basically looking at the market the other way too, because as much as the market is going up right now, it could change direction. So now I want to play price, but before I play price, I just want to jog our memory a little bit. Okay, now we spoke about the market. We spoke about the market possibly breaking, coming here and then up. That's my entry for that. We also spoke about the market respecting the ceiling right here, meaning that it will go like that and then down. Okay, so right now I want to see which one of the two will the market respect. This is very interesting because market broke out, but this break is not convincing because it broke and then it came here. It's like, lagging, and then this piece of price candlestick information here, it's telling me that the buyers are losing momentum, because if the buyers had momentum, they would have created this kind of price action or candlestick. So I just want to break that down. So now I'm gonna have to go down to the 1 hour chart. We can see with these candlesticks, guys, the sizes of the candlesticks, guys, they speak volume, you know. These candlesticks, according to the Candlestick Bible, they are a reversal pattern candlesticks. And I don't want to get into candlesticks because right now we are backtesting fair value gaps and just seeing their effect in the market. Remember this fair value gap right here. Now, this move triggered that position, and I'd like us to explore that a little further. We got entered here, we got triggered in there, and then over here we got stopped out. I just want to read something from this book. In any given moment, there is a vast difference between what each of us perceives and what is actually available in the way of possible distinctions from the environment's perspective. Take, for example, a salesperson who has learned to recognize the exact most appropriate moment to ask for order and close a sale, or an auto mechanic who knows exactly what is wrong with a car by the kind of sounds that it makes. To the inexperienced salesperson or auto mechanic, these abilities will seem like magic because they will assume that they are hearing or seeing the same things as their experienced counterparts. They are actually perceiving the different environmental information because of the differences in the structures of their mental environment. At the start of this book, I said it would be a step-by-step guide in the process of adapting yourself to the trading environment. The first step in this process of adaptation is recognizing the need to adapt. If you cannot manipulate or force the markets to change in a way that suits your need, then you will need to learn how to change yourself to suit the conditions. We could all be trading the exact same thing on the exact same time frame, but I could be trading a sell and you could be trading a buy, and we both make money. If I cannot understand what you are trading and you cannot understand what I am trading, it does not make what the other one is trading wrong. It's just that we are looking at the market from our perspective based on our mental environment. And that's just what this book has helped train me, into becoming. If you guys like this kind of content, please like, comment, and subscribe to my YouTube channel. Leave a comment in the comment section and let me know exactly what you guys would like to see me do or backtest going here on. Also, if you do have any more tips, just give them to me. If you saw me make a few mistakes, maybe with fair value gaps, or maybe there's something that I misunderstood, definitely leave a comment in the description box and I definitely will check it out. Using the exact same technique with the questionnaire from this book, I'm gonna use that and carry on backtesting the rest of the month of October 2023.
As a full-time student, I don't have the luxury of constantly checking the charts, so I've decided to become a swing trader. This means holding my trades for longer periods, which can be an emotional roller coaster. But I've found that the biohacking questions from Mark Douglas's The Disciplined Trader have really boosted my confidence in my entries. If you're a student too, how do you handle your trades? Let me know in the comments below. Thank you for watching.